Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, look to see what they're talking about, go over some news, kind of the Fed, what they're thinking, what they might do. Go over some commodity stuff like oil. I think I've got some uranium stuff. We'll cover a whole wide range of things in the stock market, maybe interest rates as well. And obviously, I'll be giving my financial opinions along the way. If you guys need any help with anything, definitely check out finding-value.com. Become a platinum member. Use the word discount in the coupon code if you want a discount. And we've got a 5 p.m. Mountain Standard Time Sunday platinum question and answer session. So you can ask me questions as well directly. Let's dive in, guys. We've got, if you want to follow me, it's at finding_finance, just an FYI. I totally agree with this post. That's why I retweeted it. It's summary of the Fed minutes for 2/22. It says almost all Fed officials backed 25 basis points hike in February. 2, restrictive policy until inflation hits 2%. 3, Fed sees elevated risk of recession. 4, a few officials backed 50 basis point rate hikes in February. Feels like a Fed pivot hopes of September 2022 all over again. So that's kind of some of the summary of the Fed minutes. Pretty straightforward there. Tavi says, we just saw the largest monthly decline in operating oil rigs in over 2 years. Energy companies are in no rush to ramp up production, and supply is likely to remain tight for longer. This is your total operating oil rigs. And we have pulled back here September, and we came back up again, and we pulled back again. This is a pretty big pullback just recently. This is also being felt by some of the energy service companies. The people who are pulling the strings are the exploration production companies, and they will impact oil drillers. So we're seeing a pullback in some of the energy service companies right now. I don't think that we can do this for forever. We can't have a downtrend in oil rigs continue to go lower for a super long time as demand is increasing. And I'll show you some demand information as well. So here's demand. This is Shabam. So onshore crude inventories have moved around to begin the year, with America stocks building and panicking oil and gas investors, whereas China inventory is declining by roughly the same amount. Rest of the world is flat at exactly 2.204 billion barrels, while demand continues to rise. Invest accordingly. So he's taken it from the big picture view. We have had inventories rise in America, but they're being offset by other areas in the world and their declines. So we're roughly flat right now, looking at supply demand and the inventory draws and drawdowns that we're seeing. The issue is demand continues to rise, and we're going to have to bring on more supply. Marry that with total operating oil rigs and the oil price where it is today, you get a mismatch of what's happening on the supply side and what's happening on the demand side. So that's the opportunity. The question is, what is going to happen in the short term in terms of pricing? And I wish I could tell you exactly what that answer is. I don't know what the answer is in the short term. We've got forces working against each other and signals conflicting each other. And I've retweeted a post here coming up just about those signals and how they are conflicting with each other, which is this one right here. I like this post quite a bit. It says the current situation, stocks are down like a 50 basis point rate hike is coming. The VIX is down like the Fed just pivoted. Oil prices are down like we are in a recession. Treasury yields are up like inflation's at 10%. Gold prices are down like we have deflation. The Fed broke the stock market. Well, these here are all signals, and I use these signals as well to figure out what the heck is going on. Problem is, these signals are all conflicting with each other, at least when you look at it going backwards. If we were to have a 50 basis point rate hike that is coming, stocks would definitely be down, and obviously bonds would be down. We've got the VIX that is stable and down. Oil prices are down like we're in a recession, which basically the interest rate hikes and oil prices move in tandem a lot of the time. They are lockstep in tandem for a lot of it. So how the heck do we have a 50 basis point rate hike or some rate hike coming and oil prices be down? It's very rare to see that in the markets. You've got treasury yields up like inflation's at 10%, especially the 10-year yield and 30-year yield. But how do you have oil prices that are down? Again, they're very well correlated. And I think either yields are going to have to go down or oil prices are going to have to go up to kind of make this all work out. Yields generally go up when inflation's up, and inflation is generally up when oil price is up because that's the most sensitive sector. I don't know how or why, something would have to be different in history this time around to have oil prices de-link from treasury yields. And if that is the case and you have like some sort of inflationary problem, you should see it in oil prices. It just goes back in this loop. And then gold prices generally go up in an inflationary environment they go up towards the back end of it. And gold prices are down like we have deflation. Now, is gold sniffing out deflation, oil prices following, and then we've got a broken treasury market yield with bond prices? Maybe international countries are just dumping bonds to get out of bonds and investing in gold, and gold is exchanging hands all around the world at the same time that the dollar is going up and yields are going up. I don't know. We've got conflicting information to some degree with some of the information. And I agree with this post here. It says, Berkshire's best opportunities always came at times of uncertainty, when others lacked the insight, resources, and fortitude to make the right judgment and commit. I think, looking at this, at least looking backwards, what I've gotten better out of this is I'm better at identifying the opportunities, but I feel like I'm getting better at this here, committing to it. Because if you really want to make a lot of money, you're going to have to, one, identify good opportunities, the best opportunities, and then two, you're going to have to commit when the price hasn't moved yet if you want the largest return. You want to get it really, really low so that you can get a nice big move out of it. So that is one thing that I am trying to do, is not just find the best opportunities that are way down there, but commit more money to it. Larger positions in very good risk reward opportunities and commit to it. So here's Dr. Jordan B. Peterson. I thought this was interesting. It says, I asked at OpenAI to provide me with a social credit score for the above mentioned people, Jordan, Elon, and whatever. And what's kind of crazy here, and this is what's wrong with AI, because I was doing some stuff with AI as well. AI, artificial intelligence, is nothing more than an information gathering system. I don't know if it's OpenAI. I can't remember if it was Chat GDP or GPT or whatever the heck I was doing. Can't remember what website it was. But you'd ask it, and all it would do is draw conclusions or draw information from a database or whatever and give you an answer. It doesn't actually think like a human being. It's not making up its own decisions. I actually think Jordan B. Peterson is actually pretty good. I also don't mind Elon Musk. I don't necessarily like him per se, but I don't think he's bad. But if we have these social credit scores and they were to influence the scores based off of whatever, this information that they arbitrarily put in some database, I just see this as complete garbage. It's a way to mind control people to some extent. And I don't know. I don't think Jordan Peterson's that bad. I don't really see him being that controversial. Yeah, he went against, he wants free speech, and people went against free speech and guided it under, some stuff that might have been, you know, I don't know, whatever it is. But I don't see him as that bad. There's nothing he says that's, I would say, that controversial. Most of it, what he says is, I would say, pretty right. Anyway, I don't like the whole AI thing, and when I was using AI, I didn't see a huge value in it. It's almost like some of the things that it returns may not be 100% accurate. So you still have to have some sort of filtering system that you inherently have as a human being and filter the information, because it can't do it for you. It just throws information. It says getting lots of DMs of discouraged people. This guy, I think, is an oil guy. If this trade was easy, predictable, non-volatile, and so on, you wouldn't be here because potential returns would be dismal. Either you believe the market will be tight or oversupplied the next few years is the main question. I'm in the camp that it's going to be tight on a worldwide basis for oil, nat gas, and energy in general. But some people, you could obviously argue and say things could be slow over the next year or two. The market becomes tight with credit expansion, and the housing market is slowing down with higher interest rates. But I also think that if interest rates were to go down, the housing market would kick back on. So it is very sensitive to interest rates at this time. I think we're at that pivot point where the housing market, if we had interest rates continue to go higher, I think it will hurt the housing market, and I think it could increase the likelihood of a recession coming. I do agree with that. The timing of it, I don't know. We're going to have to see, because there's no inherent foreclosure delinquency pressure to bring house prices crashing to like a very low level. But interest rates moving higher would put a lot of pressure on the market to move downward to sideways for a while. This is a car dealership guy. It says used car prices will likely go higher than anyone expects. Here's why. Dealers are currently selling more cars than they're buying. They can't replace their inventory because there isn't enough supply in the market. It's 2023, same store used, acquired versus sold volume, and you can see it is up there. Here's Patrick Karam, uranium miners versus the S&P 500 with data adjusted for dividends. The most behemoth of breakouts is still ahead of us. So here's ETF versus SPX. You can see we're right at that resistance line, basically coming up against it. This is a bottoming pattern, guys, and we just haven't broken out through resistance on it. It's going to take time. Be patient, and patience will bring you the money. It says investing, a never-ending test of how well you can stick to your long-term plan while your short-term emotions are screaming at you to do the wrong thing. That's so true for the majority of people. And I would say myself too. I have emotions and I do feel things. I've just got the experience to kind of suppress those emotions to some extent. Here's Ronnie. He's talking about stagflation. It says, as we approach the release of 2023 in Gold We Trust report, on the 24th of May, we will share highlights from prior reports, such as our proprietary definition of stagflation. And we've got the stagflation here. So basically, we define an economy as stagnant if real economic growth is less than 1% year on year. We consider inflation to be elevated if it exceeds 3% year on year. We collect these data on a quarterly basis. Both conditions must be met for at least 2 consecutive quarters in order to declare stagflation. Here is the Canadian 10-year crept all the way up to 3.4%. Bonds looking at a less hard landing. And what's curious here, if you look at this chart, it's more or less the oil chart. The oil chart does the same thing, crude oil, in the same type of pattern here of this consolidation, and we're moving higher. So why is crude oil in America heading lower? These usually link up together. If you have inflation, crude oil generally goes higher, or crude oil is the leading indicator of it. It kind of leads it because that's the inflation translator into the consumer price index. We've got market continues to push up. expectations for Fed funds terminal rate this year, now nearly 5.4%, and is working towards erasing expectations for rate cuts by the end of the year. So this is 221. This is last month. You can see last month where we were for the Fed funds futures curve, but look what happened here. We are pushing these rates way higher than what we were pricing a month or two ago. So the Fed funds future curve is definitely looking a lot higher. They were looking at it at a peak somewhere in June or July. This peak looks more like August, September, or October of 2023. And keep in mind, guys, generally commodities go up under an increasing interest rate environment. And right now, we could be at a kind of just a relaxation period. And when wave 3 hits, this could continue to go even higher for the Fed funds futures curve. I don't think the market or the Federal Reserve or anyone really has a good handle on how high interest rates are going to go. We've broken out of a 40-year downtrend, and I'm not exactly sure anyone knows just how high they are eventually going to go. This is the Fed rate hike expectations update. We've got that. I've talked about that before. Looking at 322, it looks like 4.75 to 5 is a high likelihood. And then you can see they keep continuing to increase it. 5.3, we're looking at about 5% or so. June up here somewhere in this range where we peak, and then we go back down somewhere around the end of 2023, which means we could have a pretty big run in commodities even this year or next year, because when these go up, commodities generally run all the way up. They may even still run, and this could be conservative. They may have to raise rates higher than what we think. I don't have the answer there, but and maybe they lower them at some point. Commodities usually do a big old kind of push off run when they go down, and then we get a crash, some months or half months later, maybe 6 months later or 5 months later after they start lowering. Here's mortgage rates through the first 3 years of the 2020s. This is lower, stayed very low in 2021, and you can see this gigantic increase. And it's increasing here this past month or two. It's heading higher. This is a huge step back for the housing market recovery as rates spike again. The seasonally adjusted mortgage purchase applications index falls 18% to 147.1. You could see that we were getting a rebound here when interest rates fell, and then interest rates turned and just went straight higher, and mortgage purchase applications went down again. So they are very sensitive to interest rates at this point. Very sensitive. It says the Bank of Japan has announced an emergency bond buying operation. That's still going on. We got the drop in existing home sales is unbelievable. Here's the drop in existing home sales all the way down to a very low level. Sales is a function of volume of units sold. And the volume has definitely dropped down. So we have low inventory, low buying, low demand, low supply, low everything. Yeah, and then that's where I'll stop it there, guys. So that's what I've got for today. Some real estate information there, some oil information, and some interest rate type stuff. We've got a mixed market here. It's getting harder and harder to figure out which direction this thing's going to go. Generally speaking, if the Federal Reserve is increasing rates, they think the market is strong. Generally, you don't get a crash when interest rates are going up from the Federal Reserve. Usually it crashes sometime after they have either paused or are going back down because they see weakness in the market, and that weakness is being noticed by everyone else, and there's your sell-off and recession. So that's what we've got for today, guys. Hopefully you enjoyed it. Give me a thumbs up for the content. Subscribe to the channel if you haven't already, and we'll catch you next time. This is Finding Value.